Well, howdy there, folks. I've just been doing a lot of work here over the last few hours, and I want to show you exactly what I'm looking at in the market. A lot of people are wondering, what's been going on in the market, where are we headed? I want to explain a change in strategy for me moving forward, and I'm going to get into this. This is going to be a very important video for you to pay very close attention to. Stop everything else you're doing and just watch this one all the way through, because this is one of those videos that will end up being very, very helpful to you in kind of understanding where we're at in the market, where we're headed, and why you might want to at least consider doing certain things now for kind of your money and those sorts of things. And we're going to look at data. This isn't just an opinion-filled video. We're going to look at a lot of data that's going to help you make your most informed decisions, hopefully for your money for the long term here. Okay, so obviously, the market has been, collapsing, crashing, whatever you want to call it. We're in one of the worst years in the history of the stock market in terms of this year for the stock market. It's just we pretty much never see years this bad ever. It's been extraordinary. Now, earnings. We've been in earnings season. Okay, we've been in earnings season, and during this earnings season, like there's been a very common theme we've seen. I've listened to, oh my gosh, I don't even know how many conference calls this earnings season. I don't know, 20, 30, 40 different conference calls so far this earnings season. And I can tell you there's one theme that keeps coming up over and over and over again during this earnings season. By the way, this is going to be the last big week of earnings, and then we're just kind of have gotten through almost everybody, okay? Two common themes have been heard, okay? One is companies saying that 2Q is going to be kind of a meh quarter. That's just what we've been consistently hearing. But the second part is everybody's expecting a much better back half of the year for their companies, 3Q and 4Q. Now, these executives of companies are usually pretty good at forecasting their companies, business models. They're not perfect. They make mistakes sometimes. But when there's a consensus on CEOs believing that certain things are going to play out certain ways, that's usually how it works out. I've seen it common, time and time again. If executives believe they're going to have a meh quarter and you're hearing that consistently, they're going to come up in that quarter. If the consensus is they're going to have a good quarter, next quarter, whatever, that usually ends up playing out that way. These CEOs and executives are usually pretty good with forecasting over the next 2 to 3 quarters. After that, they have trouble. But over the next 2 to 3 quarters, because they can see orders coming in, they can see volume coming in, they can see a lot of data that us, even as investors, we just don't get that sort of data. They're running these businesses on a day-to-day basis, right? So they see stuff that we have no clue that's going on, right? And so there's been a consensus we've seen consistently this earnings season, right? Now, the market is in a horrible place, or has been in a horrible place. As of a couple trading days ago, the NASDAQ has been down over 30%, and the Russell was down around 31%. This doesn't ever happen in the market. That's what you got to understand. For a year to start out this bad through the first 5 months, this just doesn't ever happen. Now, also, what you got to understand is for the market to ever draw down 30+%, very rare. And we also simultaneously have a very weird situation where the S&P 500 has been holding up way better than the NASDAQ and Russell. That almost never happens either. So we're in a really weird, freakish time. I will say that we just don't usually see this time. But if we look at the S&P 500, for instance, right, which usually the S&P and NASDAQ are usually within a couple percent of each other. But if you look at history, right, what you're going to find is this is the max. This is from Fidelity Investments. I took this all the way back to 1980, okay? What you're going to find is the S&P draws down 20% or more hardly ever. And this is the max decline for an entry year for the S&P 500. It hardly ever goes down more than 20%, right? And almost never goes down 30% plus. So we did in 1987, we did in 2002, we did in 2008, and we did in 2020. Right? So in 87, they had a crazy freak stock market crash out of nowhere. And one day, I think the S&P 500 alone was down 22%. It was ridiculous. We had obviously a lot going on. That was a whole dramatic situation in itself on many different fronts, right? '08 was, we were afraid we were going to lose the entire financial system, like JP Morgan, Bank of America, Wells Fargo, like people really thought even those banks were going to go under in that situation. So we almost lost the entire financial system. Plus, you had real estate crash and everything else, right? And unemployment go insanely high. And then once in a 100-year health event came out of nowhere, the pandemic, right? And so this is very important to understand that what we're going through right now almost never happens. It does happen every once in a while, but it is very few and far between. And I mean very few and far between. This is not something that generally plays out, okay? Next thing I want to take a peek at here, because a lot of people look at that, right? And they say, oh, I want the stock market to crash more and more and more. You got to understand, if you're talking about the NASDAQ drawn down 35%, 40%, 50%, usually what happens in that sort of scenario is you have a massive recession, right? And it's not really good for people. And so that's why I wouldn't wish it on that sort of situation to play out. What you're looking at here, this is, basically like SNAP benefits, food stamp benefits. So in 2007, we had about 26 million Americans on that. And by 2010, 40 million, right? We jumped from 26 million to 40 million in a matter of a few years because, a lot of folks were out of work and the economy was in shambles. It was in a horrible place, right? And in 2009, the guy you're watching this video from, I had a little food stamp money for a little bit there in 2009. I think I got $24 a week or something like that in 2009. And so it's not fun to be on food stamps. I've been there, done that, and it's no fun. And you should never, wish that on people, essentially, okay? Now, 2019, we finally started to come out of this, and then the Rona happened, and next thing you know, now we're 40 million plus again. Plus, that puts a whole negative cost on the government side, right? Tax money and all those sorts of things. So it's not a good situation, right? Now, there's something very interesting that is starting to happen in the market. Very interesting. FTX US is the crypto exchange I personally use for any moves I ever make in the crypto market. But why do folks like myself use FTX? Why are folks like Steph Curry, Tom Brady investors and partners in FTX US? Well, let me tell you a little bit about them. FTX US is one of the largest and most trusted exchanges out there with millions of users on the platform. They're also launching stocks pretty darn soon, which is going to be amazing because then you'll be able to do stocks and cryptos right through the same app. Absolutely amazing. They also make it insanely easy to dollar cost average on positions and do recurring buys. As we all know, it is very, very difficult to time the market. It's the easiest way to buy crypto, 24/7 customer support, 85% lower fees than competitors. And right now, when you set up an account through the pinned comment down there and use my referral code HOLYSMOKERS, you can get up to $100 in free crypto when you trade through the platform. And also, with any trades above $10, you get free crypto as well. So go ahead and take advantage of this now. Once again, check out that pinned comment down there. Use referral code HOLYSMOKERS. And thank you, FTX, for sponsoring today's video, as always. And what this is sentiment, right? And so the sentiment is starting to get more bullish. Now, the key word is starting. Are we in a bull market or anywhere even remotely close? Heck no. Heck no. You're still talking about almost half of investors are bearish on the stock market for the next 6 months. But the very important thing is the tide is turning. And you're from 59%, which is that's one of the highest numbers we've ever seen in the history of the AII investor sentiment. That's a number even worse than during the Great Recession, okay? You've almost never seen time periods when we're talking about 59, 60% of investors are bearish on the market for the next 6 months. So the tide is slowly starting to turn, right? Like I said, we got a long way to go. In normal market, historically normal, about 30% of investors are bearish on the market for the next 6 months. That's normal. And normal is about 38% of investors are bullish on the market for the next 6 months, right? And about 31% are basically kind of in a neutral place, right? So we got a long way to go before, most investors are bullish on the market and not bearish. A long way to go. But let's be very, very clear. Let's not confuse this for even a second. The tide is starting to turn. Now, when the tide starts to turn in the market, you have to acknowledge that, and you have to understand, okay, just like you have to acknowledge, if you're going from a bullish market to a bearish market, it's like, oh man, things are just getting worse. Even more people are turning bearish. Even more people are turning bearish. Now the tide recently has peaked and is starting to turn. Now, in order to get this number back down there, I don't even know if we can get it back down there to like a 60% type number, regardless of what happens, right? This was so big for the market. The market kind of overlooked this week, but I promise you, like I said, the market, I said this in a video earlier in the week, the market has a good poker face, a really good poker face, to really know how it feels. And I can tell you, this is one of the biggest things to happen in the market in the past year or two. The fact that the rate of increase of inflation came down is massive. And I know it's only a 0.2%, but the fact that it came down 0.2%, we haven't seen it go down 0.2% a long, long time. The fact that that happened is insanely important for the market. Once again, we're talking about the tide is starting to turn. I think May numbers are going to come in Under 8. I'm pretty darn confident it's going to come under 8. I'm thinking maybe 7 something, maybe low 7s. I think there's a high probability that June could be in the 6s. I think there's a high probability that by the end of the summer, we're at the 4 or 5 range, okay? It's going to happen really, really quickly, in my opinion. Now, how do I feel so confident about this, right? Well, many various factors. You got to always think about the comps year over year. And in order to get inflation to stay up at these insane numbers of 7%, 8%, 9%, right? You need everything to continue to get much, much more expensive versus where it was a year ago. Well, what we're starting to see is prices actually starting to drop quite substantially. Look at lumber. Lumber's quite significantly lower today than it was essentially a year ago, right? Iron ore, significantly cheaper. Look at how much the price difference is here, guys. 225 versus 124. It's not like you're talking about, oh, it's down a little bit. It's down massively. And once again, you need all these things to continue to go up and up and up if you're going to talk about inflation continuing to rise. Steel, significantly down year over year. Now, the one bad thing we have going for us when it comes to inflation is still like crude oil, natural gas, all those sorts of things, obviously, are significantly higher this year versus last year. That could change. That's all I'll say about that. That could change. Usually gas will usually peak right around June, July, sometime around there, summertime, and then you start demand starts dropping and you kind of get a drop there. So, that could be something that goes from like a headwind against us to actually a tailwind behind us starting this fall, okay? If you look at copper price, it's dropped significantly year over year here. Obviously here it was getting bad, and look at how much it's dropped recently. That's the thing, and these numbers will start to show up in inflation. It ends up hitting things, right? You're seeing stuff like this. Used car buyers are seeing relief. Used car prices are starting to come down and get to more normal ranges, right? And I don't see that trend. Ending anytime soon, to be honest. With how much interest rates are going up, and I don't think used car prices are going back up. If anything, I think they're going to continue to go down and down and down. Especially when you talk about gas prices as high as they are right now. Who's like, I got to go buy a new car right now? Heck no. And so I think that's going to be something that's honestly pretty darn big. The fact that used car prices are just continuing to drop and drop and drop, right? You see things like this. GPU prices are starting to drop, right? And so across the board, the rate of increase of inflation is going to start coming down and down and down significantly. And as you get quarter after quarter after quarter of that inflation rate dropping, you want to talk about a breath of fresh air for this market, guys? This is what I'm talking about. This sentiment is slowly getting better and better and better. And we have gone from kind of almost like a peak fear situation around the Fed, around inflation, around pricing of everything, to now things are slowly starting to get better and better and better and better, right? The stocks I've been buying for the last several months very heavily, right? What have these companies been saying? So the Chef, they beat their revenue by a mile. They came in with 37% revenue growth when 22% was expected. The Chef also says that margins will increase in the back half of this year. You want to talk about something that's massive for the stock price? And that's going to be huge for this company as their margins increase in the back half of this year. It's going to be a game changer for the stock price, because then it becomes not just a growth company, but then it becomes a growth company that's improving their margins quarter in and quarter out. And so that's going to play out, right? Corsair Gaming's talked about those GPU prices coming down. And that's one of the biggest things that could possibly happen for their business. That's a huge thing outside of like a big game being launched or something like that. Because if people are building new PCs, Corsair benefits massively from that because of all the other things people buy, and Corsair is a direct beneficiary. With GPU prices being so dang high in the past year or so, a lot of people haven't really wanted to. Plus, Corsair had these ridiculous comps they had a comp against year over year when the stimulus money and everything was out there and everybody was forced to be at home. All that's going away now. And so Corsair is setting up for the back half of this year to have great numbers, and the story is just going to get better and better and better as the year transpires on, right? On a same exact situation, all that sanitizer pull forward they had the last couple quarters that they had a comp against year over year, all that's long gone. And so their comps get easier and easier and easier as this year transpires. The margin story is going to get better and better. The profitability story is going to get better and better. Oatly, same exact situation. This one's getting their facilities up and running in a massive way and will be at scale by the back half of this year. That's going to be huge for their margins. That's going to be huge for their revenue growth in keeping products in stock, because if there's something we know about Oatly, their velocity is ridiculous. I mean, like, they sell out so dang fast, it's incredible. And then they got to try to stock the product. And the fact that they're going to get those facilities to scale, over 3Q, 4Q, it's going to be huge for margins. It's going to be huge for their entire business model, their revenue growth, everything across the board. And so when I'm looking at the stocks, especially the ones I've been buying recently, but it goes way further than just those, the story's going to get better and better and better as the quarters move along this year and as we get closer and closer to 23, okay? Now, simultaneously, what did Wall Street tell us, okay? I think one of my favorite times to watch, channels like CNBC or whatnot are around December and January of the year, because basically they have all these, different fund managers on and whatnot, and they give their forecast on what they expect to happen in the year ahead, right? And so I watch countless of these individuals go on TV, especially in January. And these folks that run money, the folks that work on Wall Street, like the real Wall Street people, right? And what they consistently told us when they would go on these programs is expect to have a very volatile market in the first half of this year that's probably going to struggle with a big recovery in the second half of this year, okay? Now, if all these people think that, right, all these Wall Street types, well, shoot, what are they going to make happen? They're going to make that happen. They're going to make the market very volatile. They're going to make some massive sell-offs. And then if they want to push pricing up and buy in the back half of this year, they're going to do just that. And guess what has played out? That exact thing. The exact thing they were all talking about is going to happen is happening right in front of our eyes, right? And so, that's just like think about it. Imagine you have 5 hedge fund managers in a room that control collectively $100 billion, right? And these 5 hedge fund managers are like, hey man, in the first half of this year, we need to be sellers of the market and don't buy, right? Okay, so then those 5 hedge fund managers do that, right? And you can say that maybe it should be illegal that they're doing that, but that is what it is. I'm not even going to get into that debate. And so they don't buy. They don't buy. And if anything, they put more selling pressure on the market. And they say, hey, let's short, let's buy puts. And we'll go long in the back half of this year. Late summer, we'll start going long, 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 right? And we'll switch those puts to calls. And we'll start bidding up these stocks that have already been devastated because, this is the way it plays out, right? And if Wall Street wants to do something, they're going to do whatever they want to do, right? That's just the bottom line when it comes to that. The Federal Reserve has been the enemy of the stock market, right? Because the inflation rate has been so insanely high. But what happens when, everybody's talking about 75 basis points and this and that. But what happens when the inflation rate drops to 7%, 6%, 5%, 4%, which is going to happen? It's going to happen actually really quickly. Then 3%, right? Well, then all of a sudden, people aren't talking about 75 basis points of raises. Then they start talking about no raises, maybe 25 basis points, maybe rate cuts if you had any actual worries in the economy. Maybe the Fed putting the money printer on again. The story starts to shift very, very quickly. Just like the story in a matter of a year went from the Fed's money print like crazy to all of a sudden, talking about 75 basis points, talking about 100 rate hikes this year. The stories can shift very, very quickly in the market, right? And so when I look at all this, right, I think about how I want to be over the next 2 or 3 months, and I actually want to step up my level of aggressiveness in this market. I have to get out ahead of Wall Street. Now, I do not believe we're necessarily going to be in a 2008. So I'm not going to bank that the NASDAQ's going to fall 40 or 50%. It's always a possibility. But I would rather be extremely aggressive right now and over the next few months, especially if the stock market crashes anymore, okay? Be as aggressive as possible, building, adding more and more ownership, knowing that Wall Street has telegraphed their move, which is going to be buying in the back half of this year, right? And a situation where the sentiment's already starting to shift to just a little bit better, right? I got to get out ahead of that. And I can't sit on the sideline and say, I'm going to keep a little back here in case, we drop 40 or 50%. Because I can't bank on that. I would call that a very slim chance. It's a possibility, but I would give it maybe like a 10% probability. So it's either I add as aggressively as I can possibly now for the next few months, right? Or I try to wait on a 10% probability where the NASDAQ falls 40, 50%. I don't want to wait on a 10% probability. I want to take advantage of the deals I have in front of me right now and be as aggressive as possible. So I'm going to be literally max aggressive for the next several months in this market. My plan is no matter what, all of 2022, I'm buying, but I'm telling you this next few months, I'm going to be literally as aggressive as possible. As aggressive as possible. And the reason being is everything is slowly starting to get better. The sentiment's starting to shift better, better, and better. And I don't see that changing, and I don't want to bank on the NASDAQ going down, 40, 50%. It's a possibility, but it's a low probability. So hope you guys enjoy this. As always, thank you FTX for sponsoring today's video. Make sure you check out pinned comment down there, sign up for that, and trade with FTX and get your free crypto while they're still giving it away, guys. Much love and have a great day.